Markets edged higher in the latest session, led by real estate as the top-performing sector, while tech strength kept the broader indices in the green. The VanEck Semiconductor ETF jumped 2.1%. Its moat scores none out of 100, data not available. While macro headlines focus on sentiment, pure hardware momentum drives performance as key constituent Taiwan semiconductor projects 80% advanced node utilization. This concentration in leading-edge wafer production anchors the entire rally. Our structural teardown reveals whether this hardware exposure can sustain its trajectory. SMH surged 2.08% to $584.83 as hyperscaler capital expenditures force immediate hardware procurement across global supply chains. Short-term technical moving averages indicate consolidation, but physical silicon demand drives immediate fund performance. Nvidia leads the fund allocation at a heavy 20.8% weight. Nvidia drives current momentum through dominant market share in data center graphics processing units. TSMC sits second at 9.6% weight. TSMC controls global advanced node semiconductor fabrication and complex chiplet packaging capacity. Broadcom holds a crucial 6.6% weight. Broadcom captures custom application-specific integrated circuit design and high-speed data center networking fabric demand. Advanced Micro Devices carries 5.7% weight. AMD challenges dominant accelerator architectures. Micron Technology represents 5.2% weight. Micron captures critical high-bandwidth memory cycles. Hardware innovation dictates cash flow direction. Samsung showcased next-generation high-bandwidth AI memory solutions at Flash Memory Summit 2026. High-density memory interfaces remain essential for modern neural network accelerators. Compute architectures fail to run at peak efficiency without maximum memory interconnect speed. This specialized equity structure creates severe structural dependency across the supply chain. The top 3 holdings comprise 37% of total fund assets. A failure at a single packaging facility cascades across the entire semiconductor value chain. SMH provides pure silicon exposure, but exposes investors to structural supply chain concentration. Systemic risk remains extremely elevated. Open the hood on the VanEck Semiconductor ETF. The largest single driving, MU at plus 4.9%, carrying 5.2% of the fund. Wall Street PitchBook's market VanEck Semiconductor ETF as broad exposure, but top 5 holdings control 48% of NAV. Nvidia alone commands 20.8% of the entire fund. This is not a diversified basket. It is a concentrated execution engine built for AI hardware compute and advanced foundry capacity. PitchBook's promise broad sector exposure. The actual holding composition tells a far more focused story. You are buying leading-edge silicon designs and packaging bottlenecks, not mature legacy microcontrollers. AUM and expense ratio data are unavailable in current reporting, but performance exposes fund efficiency. SMH surged 50% YTD, building on a 56.7% 3-year average return. Compare that to direct benchmark peers over the last month. Competitor SOXX declined 1.6%, allowing SMH to outperform it by 0.6 percentage points, while SPY gained 2.3%, beating SMH by 3.4 percentage points. Semiconductor concentration drives relative performance. Macro conditions stay stable, with Fed rates at 3.63%, inflation at 0.6% YOY, and unemployment at 4.1%. The yield curve remains positive at plus 0.48%. SMH channels institutional capital directly into the highest margin hardware monopolies. High concentration creates single-stock volatility risk if top holdings pull back. Nevertheless, the overall portfolio structure reflects true engineering reality over standard fund marketing. SMH is trading at a 2.7% premium to NAV. That's retail demand outpacing institutional fair value. Yet the 5-day volume is only half the 20-day average. Outflow. The money that's leaving is institutional. The premium is retail, chasing the AI narrative. RSI sits at 51. Price is above the 20-day, but below the 50-day moving average. Momentum is sideways, not trending. The bullish MACD crossover is a lagging signal. It tells you where the tape has been, not where it's going. The fund's marketing calls this diversified tech exposure. The reality, 65% of NAV is concentrated in the top 5 holdings. When the Trump tariff headlines hit, those 3 names alone represent 47% of the fund's exposure to export controls and supply chain friction. The narrative says AI hardware demand is insatiable. The data says the fund is structurally exposed to geopolitical risk that Wall Street PR teams are downplaying. Samsung just showcased HBM4 at FMS 2026. Memory bandwidth is the new bottleneck, not compute. SMH's weighting in memory fabs is 8%. The fund is still engineered for the last cycle, not the one that's actually printing revenue. Institutions are pulling capital. Retail is paying a premium. The narrative is AI hardware. The structure is legacy concentration. The verdict, SMH is a narrative filter, not a sector proxy. The structural case for this engineered instrument relies on pure hardware momentum. SMH generated a 50% year-to-date return, outperforming the broader NASDAQ benchmark by capturing the artificial intelligence build-out. Unprecedented demand for high-performance GPUs and memory directly expands top-line revenues for core constituents like Nvidia, AMD, and Micron. While the CNN Fear and Greed Index reflects fear at 27, physical silicon demand remains structurally intact. The primary structural threat is policy risk driven by escalating United States export curbs to China. A renewed technology export restriction chokes off critical revenue channels for constituent chipmakers. Furthermore, a steady 5.25% Federal Reserve policy rate keeps corporate borrowing expensive. Semiconductor firms delay building multi-billion-dollar fabrication plants when debt financing stays elevated. We track 2 critical fund structure signals to assess operational durability. A fab outage in Taiwan or process node failure instantly impacts nearly a third of this net asset value. Second, we track policy exposure and CHIPS Act capital flows against ongoing export constraints. The lab assigns SMH an AI ETF score of none out of 100 for fund structure durability. The single metric that will shift this judgment is holding concentration within the top 2 positions. Excessive constituent concentration turns a broad sector instrument into a single-node supply chain risk vehicle. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 3.1%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. Top signal, SMH's data blackout hides a critical margin squeeze. What competitive risk deserves more attention in the SMH story? This isn't financial advice, just engineer-level analysis. Markets move fast, risks shift, and past performance never guarantees future returns. Always run your own numbers before pulling the trigger. That's how we stay sharp in the lab. Subscribe so you don't miss Thursday's deep dive. We're tearing down Rocket Lab. Stay curious.